Hey guys, what's up? Welcome back to another video. In today's video, I'm going to be talking about a stock that is pretty well known in the market right now, and it might be presenting a good buying opportunity right now because it's tumbled quite a bit over the last year. So thanks in advance for leaving a like on this video, and let's get right into it. So the stock I'm going to be talking about in this video is Zoom, and we can see that over the last year, Zoom is down 70% or almost 71% here over the same time period that the overall market, the S&P 500, is down about 16%. So they're obviously not doing as well as the overall market, but that could mean that they present a good buying opportunity. And so we're just going to look into their financial statements and then use a discounted cash flow model to figure out the intrinsic value per share of their company. And so for those who might not know, Zoom is essentially a platform that allows people to communicate remotely. And they actually have a subscription revenue business model. So they offer different plans, as we can see right here, all the way from basic up to their most expensive, which is enterprise. And they use this to basically create their recurring revenue stream for their business. And so right here we have their quarterly report for their most recently reported quarter, which was the second quarter of 2022. And we can see right here that this is their balance sheet where they're basically comparing their statement of financial position from July 31st, 2022 to the period ending January 31st, 2022. And so we can see that over the course of that time period, over just a few months, basically half of a year, we can see that their total assets have increased from about $7.5 billion to about $8 billion of total assets. And then we can also see that the majority of their business is financed by equity as opposed to liabilities. They have about $2 billion worth of total liabilities and about almost $6 billion of total stockholders' equity. And then we can also see that although their stock price has declined 70% over the last year or so, their business has actually been growing as a result of an increase in retained earnings, as we can see right here, from about $2 billion to about $2.2 billion. So although their stock price is declining, their business is actually growing and doing well. So if I scroll down here to their income statement, this will show us their performance for the second quarter of 2022 in comparison to the second quarter of 2021. And then on this side, they have their performance for the first half of 2022 compared to the first half of 2021. We can see that for the second quarter comparison that Zoom's revenue year over year has actually increased by about 8% from about $1.02 billion worth of revenue to about $1.09 billion worth of revenue in 2022. And so obviously, as I pointed out before, their stock price is down 70%, but their business's revenues are growing. And we'll see a little bit for why that might be. But we can see right here their gross profit margin has stayed pretty similar. They experienced similar cost of revenues. Gross profit increased from about $760 million to $825 million. But curiously enough, if we scroll down here to look at their bottom line net income, we can see their net income has actually declined from about $316 million to $45.7 million, even though their total revenue has increased over the same period. And so the reason why that is because if we go into their operating expenses here, we can see that they increased their expenditures for research and development as well as for sales and marketing. So this increase in their revenue might be as a result of an increase in their marketing expenses, which makes sense because, obviously when everybody was in lockdown, they didn't have to spend as much money on marketing to grow their business because everybody was just gravitating towards their remote communication platform. But now that they're actually trying to increase their revenues continually over the period from when people are moving from remote back to face, it makes sense that they would end up spending more money on marketing in order to try to continue to increase their revenues, even though people are going back to face communications. But that being said, we can also see that the decrease in their net income came as a result of losses that they experienced on their strategic investments, whereas in the second quarter of 2021, they actually experienced gains on their strategic investments. So a couple of increased expenditures and losses for the second quarter of 2022 to 2021 ended up resulting in the decrease in net income year over year. And lastly, if I go to their cash flow statement on page 11, we can see that the net cash provided by their operating activities also declined for the first half of 2022 compared to 2021, from about $1 billion to about $780 million. But then we can also see that even though their net income has decreased year over year, they've actually repurchased a lot more common stock in the first half of 2022 in comparison to 2021, sitting at about $425 million spent on repurchasing shares of their own stock. So that might be an indication that Zoom actually believes that their own common stock is undervalued at the moment, which is why they're buying up more shares of their own stock. And obviously, that's going to end up returning more value to their shareholders in the long run, because if they're reducing the amount of shares outstanding on the market, then that's obviously going to increase the share price. And something else I actually want to touch on from their income statement here is that, obviously, like I said before, they spent a lot of money on sales and marketing, and this actually ended up resulting in an increase in the amount of enterprise customers that they had year over year. Their enterprise customer base actually grew about 18% year over year to about 204,000 enterprise customers. And this is obviously their most expensive subscription plan. So it's pretty important for them to grow this part of their business. And since it's a subscription plan, it's a reoccurring revenue. So they don't necessarily have to continue to spend money on marketing in order to retain the customers that have already subscribed to their platform. And so just because they spent a lot of money on marketing this year might not necessarily mean that they'll continue to spend a lot of money on marketing in the following years, because they don't have to continue to find new customers since they have a recurring subscription revenue model. So next, I want to figure out the intrinsic value per share of Zoom. And these estimates I all got from Yahoo Finance. Basically, analysts from Yahoo Finance are estimating that Zoom is going to grow at about 13.5% year over year compounded annually for the next 5 years. I was conservative for the next 5 years after that, and I cut that value in half. They had about $1.49 billion worth of free cash flow on their financial statements for 2021. They have about $5.42 billion worth of cash on their balance sheet after subtracting their net debt. And then they also have about 250 million shares outstanding at the moment. And so with these metrics in mind, their intrinsic value per share comes out to be estimated to be about $128 per share, with a 50% margin of safety of $64 per share. And so if we compare that to their current share price, we can see why some investors might think that Zoom is presenting a strong buying opportunity right now. And that's because they're literally trading close to their 50% margin of safety, below their 30% margin of safety, and definitely far below their estimated intrinsic value per share, which is maybe possibly one of the reasons why Zoom themselves are also buying back shares of their own company, because their stock price has tumbled, but obviously, as we saw, their revenues are continuing to grow, and those increases in their marketing expenses and their other operating expenses might not be permanent throughout into the future as the business continues to grow and they get more subscribers for their subscription plans. And so lastly, what I wanted to do was I wanted to compare Zoom to their competitors in this industry. Obviously, Zoom is not the only company that provides remote communication platforms for customers. Microsoft with Microsoft Teams and Cisco with WebEx, they also do something similar. So I want to compare these companies against each other in terms of business efficiency, because obviously it wouldn't be fair to compare Microsoft to Zoom or Cisco, since Microsoft is literally the second biggest company in the world. But if we compare their business ratios, we can get a better look at the efficiency with their business without having to consider the billions of dollars of revenue that Microsoft experiences over Zoom and Cisco. So right here, we can see the gross profit margin across the three companies. Zoom has the best gross profit margin at the moment with about 74% gross profit margin. They also have a middle of the pack net profit margin, but almost right up there with Microsoft. Both are sitting at about 33%, whereas Cisco is sitting at about 22%. And then it looks like Zoom has the best business efficiency in terms of getting a return on their assets in relation to Microsoft and Cisco in comparison. Which Cisco, obviously, they look like they're actually bottom of the pack in all ratios compared to Microsoft and Zoom. So from a competitor analysis, it looks like Zoom's business efficiency in this industry is pretty good. They're keeping up with Microsoft and Cisco. And also from this intrinsic value analysis that we just did, looks like they could be trading well below their intrinsic value per share, even though their stock price, has declined 70%, their business is growing year over year, and those increases in operating expenses might not continue into the future if they're able to retain the amount of subscribers that they've already accumulated and then just grow their business from there into the future. So Zoom is definitely an interesting stock for me. I'm going to be keeping my eye on it. Not too sure if I'm going to be buying into it at this share price. I might want to see it fall to around the 50% margin of safety before heavily considering it for my own portfolio. But I'd love to know what anyone watching this video thinks about Zoom Technologies or Zoom Video Communications. Is it a good stock to buy into right now? Let me know in the comment section down below what you think. Leave a like on the video. As always, subscribe to the channel, and I'll see everyone in the next video.